Welcome to the game of wealth. It's a mindset where strategy, hard work, and smart decisions lead you to success. Get ready, because only those who think big will win. Investing can seem overwhelming, especially for beginners, but it's one of the most powerful ways to build wealth and secure your financial future. Whether you want to save for retirement, grow your money, or achieve financial independence, smart investing can help you get there. In this video, we'll break down the basics of investing into 10 simple steps so you can start your journey with confidence. Let's dive in. Part 1. Understanding the basics. Investing is a fundamental aspect of personal finance that allows individuals to grow their wealth over time by putting their money into various types of assets. It's important to distinguish investing from saving because while saving typically involves setting aside money in low-risk, low-return accounts like savings accounts, investing aims to put your money into vehicles that have the potential to increase in value, generate income, or appreciate in worth over time. This could be in the form of stocks, bonds, real estate, mutual funds, exchange-traded funds, ETFs, or even starting a business. Part 2. Setting financial goals. Before diving into any kind of investment, it's crucial to have a clear understanding of why you are investing in the first place. Setting specific financial goals is the foundation of any investment strategy, as it helps guide your decisions and ensures that your investments are aligned with your needs and objectives. Take a moment to consider what you hope to achieve with your money. Are you saving for a comfortable retirement, planning to purchase a home, building an emergency fund, funding your children's education, or perhaps growing wealth for future financial independence? Each of these goals will require a different approach when it comes to selecting the right investments. Your financial goals can generally be broken down into short-term and long-term objectives. Short-term goals typically involve needs or desires that will require your funds within a few years. Part 3. Understanding risk and return. Every investment carries some level of risk, and understanding the relationship between risk and return is fundamental to successful investing. Risk refers to the possibility that your investment might not perform as expected, leading to a loss of some or all of your money. Return, on the other hand, is the profit or income generated by your investment over a specific period of time, whether through price appreciation, dividends, interest, or other forms of growth. Essentially, the higher the potential return an investment offers, the higher the risk associated with it. This concept is crucial because it helps investors make informed decisions based on their financial situation, goals, and comfort level with uncertainty. Investments can be broadly categorized into high-risk and low-risk options, each offering different potential returns. High-risk investments, such as stocks, have the potential for significant returns. Part 4. Building an emergency fund. Before diving into the world of investing, one of the most important financial steps to take is to ensure that you have a solid emergency fund in place. An emergency fund is essentially a safety net that acts as a buffer in case of unexpected financial challenges, such as medical emergencies, car repairs, sudden job loss, or any other unforeseen circumstances that could affect your income or ability to meet your regular expenses. Having this fund in place not only provides peace of mind, but also protects you from the need to withdraw money from your investments prematurely in times of crisis. The general recommendation is to aim for an emergency fund that covers 3 to 6 months' worth of living expenses. This amount can vary depending on your individual circumstances, such as your job stability, family size, health, and overall financial situation. If you have a more unstable income or dependence. Part 5. Choosing the right investment accounts. Choosing the right investment account is essential for achieving your financial goals while optimizing tax efficiency and accessibility. Retirement accounts like 401(k)s, traditional IRAs, and Roth IRAs offer tax advantages that can significantly boost long-term growth, with Roth IRAs providing tax-free withdrawals in retirement. For flexibility and access to funds at any time, taxable brokerage accounts are ideal, though they lack tax benefits. Specialized accounts like 529 plans for education savings and health savings accounts, HSAs for medical expenses, offer unique tax advantages that can be valuable depending on your needs. Balancing contributions across these various accounts based on your goals, timeline, and tax considerations is key to building a robust investment strategy. Part 6. Diversification. Don't put all your eggs in one basket. Diversification is often considered the golden rule of investing because it helps reduce risk and enhance potential returns over time. By spreading your investments across a broad range of asset classes, industries, sectors, and even geographical regions, you minimize the impact of poor performance from any single investment. For example, if you invest solely in technology stocks and the tech sector experiences a downturn, your entire portfolio could suffer significant losses. However, if your investments are spread across various industries such as healthcare, consumer goods, energy, real estate, and technology, the negative performance of one sector is likely to be offset by positive performance in others. Additionally, diversification isn't limited to industries alone. It also includes asset classes such as stocks, bonds, real estate, commodities, and cash. Part 7. Start small and be consistent. You don't need a large sum of money to start investing. In fact, many successful investors began with modest amounts and gradually built their wealth through disciplined, consistent contributions. Thanks to modern investment platforms and apps, it's now easier than ever to start investing with as little as $10 or even less. These platforms often offer fractional shares, allowing you to buy portions of expensive stocks or funds that would otherwise be out of reach. The most important factor when starting with a small amount of money is consistency. One effective strategy for building wealth over time is dollar cost averaging (DCA). This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you purchase more shares when prices are low and fewer shares when prices are high, which can potentially lower your average cost per share over time. Part 8. Avoiding common investment mistakes. Beginner investors often fall into various traps that can significantly hinder their progress and potential returns. Some of the most common mistakes include emotional investing, chasing trends, neglecting proper research, overtrading, and trying to time the market. Recognizing and avoiding these pitfalls can make a substantial difference in your investment journey and help you achieve consistent, long-term growth. Emotional investing is perhaps the most prevalent mistake, where investors allow fear and greed to dictate their decisions rather than adhering to a well-thought-out strategy. During periods of market volatility, fear can prompt investors to sell off assets prematurely, locking in losses instead of allowing time for recovery. Conversely, greed can lead to reckless decisions, such as pouring money into speculative stocks or assets during a bubble. Part 9. Understanding fees and taxes. Understanding fees and taxes is crucial for maximizing your investment returns, as both can significantly erode your gains over time if not properly managed. Every dollar lost to fees or taxes is a dollar that isn't compounding and contributing to your long-term growth, so it's essential to be aware of these costs and take steps to minimize them wherever possible. Part 10. The power of long-term investing. Successful investing requires patience. The stock market has ups and downs, but history shows that long-term investors benefit from overall growth. Compounding interest works best when given time, so the earlier you start, the better your financial future will be. Investing is one of the best ways to build wealth, but it requires knowledge, patience, and discipline. Start small, stay consistent, and think long-term. If you found this video helpful, don't forget to subscribe to my channel for more information on how to make smart financial decisions and grow your wealth.